If you die with $1 million in the bank, you've essentially worked years of your life for free. It's a jarring way to look at a career, but after sitting with Bill Perkins' philosophy in Die with Zero, I honestly hadn't thought about it that way before. We're taught to save, to hoard, and to be prudent, but Perkins argues that money is really just a representation of life energy. If you spend your time working to earn money you never use before you die, you've effectively wasted the life energy you spent to get it. You traded your limited hours on this earth for a pile of paper that's going to sit in a vault while you're gone. That realization stayed with me because it reframes the entire goal of a successful life. It's not about who has the biggest number at the end. It's about life optimization. He illustrates this through the story of a couple named Aaron and John. They were facing John's battle with a rare cancer, and suddenly, their someday became right now. Aaron chose to leave her job immediately to spend those final months with John and their family. It wasn't the fiscally responsible move, according to a traditional financial advisor, but it was the only move that maximized their remaining life energy. Most of us live as if we have unlimited time, delaying our gratification for a future that isn't guaranteed. We're often reactive instead of being purposeful with the time we have left. I kept coming back to this idea that the utility of money actually changes as we age. $1,000 spent when you're 25 buys a completely different experience than $1,000 spent when you're 85. Think about a friend of the author's, Jason Rufo. In his 20s, Jason borrowed money, from a loan shark even, just to go backpacking through Europe. On paper, that is a financial disaster. But the stories of cultural discovery and self-discovery Jason brought back shaped who he became for the rest of his life. Perkins, who stayed home being responsible and frugal at the time, actually regretted it. By the time he finally made it to Europe at age 30, he was a different person. He couldn't have the 20-something experience anymore because that specific window had closed. This leads to what Perkins calls the memory dividend, which I found to be one of the most powerful shifts in perspective in the book. When you pay for an experience, you aren't just paying for the time you're actually there. You're buying a memory that pays dividends for the rest of your life. Every time you think back on that trip or share a laugh about it with a friend, you get a payout of joy. This is why investing in experiences early is so much more effective than waiting until retirement. If you go on a big trip at 30, you have 50 years to collect that memory dividend. If you wait until you're 70, you might only have 10. Experiences aren't just one-offs. They're compounding assets for your fulfillment curve. There's a funny story early in the book about the author being called an idiot by his boss, Joe Farrell. In his 20s, the author was extremely frugal, saving every penny he could. Joe told him he was being foolish because his future earnings were likely to be much higher, so he should spend more freely now while he had the health to enjoy it. This isn't about being reckless, but about consumption smoothing. Balancing your income and spending across your whole life, rather than living on autopilot. Rigid financial formulas, like saving a fixed percentage of your income, don't account for the fact that certain experiences simply cannot be postponed. Your ability to enjoy wealth inevitably diminishes as your health deteriorates, so you have to invest in your health early to ensure those memories can even happen. If you've stayed with me this far, you're probably starting to see the pattern here. But this next part is where the logic gets really challenging for most people. What about the kids? This is usually the first objection people raise when they hear about dying with zero. But Perkins looked at the data, and it's sobering. Most people in the United States don't receive an inheritance until they're around 60 years old. Think about that for a second. By 60, you're usually established. You've already bought your house, and your own kids are grown. He mentions Virginia Collin, who received an inheritance when she no longer desperately needed it, which meant the impact was muted. Perkins' challenge is simple. If you want to help your kids, give it to them between the ages of 26 and 35. that's when it can actually change the trajectory of their lives. A legacy isn't a check left in a will. It's the help you provide and the memories you share while you're still here to see the impact. The same applies to charity. He points to philanthropists like Chuck Feeney, who adopted a giving while living mindset. This ensures that financial aid reaches those in need sooner, which significantly magnifies its societal impact. Waiting until you die to pass on wealth involves a massive amount of risk because life is unpredictable. You're essentially guessing when your money will be most useful. Now, I found myself reflecting a lot on what he calls the small deaths. He shares a personal moment of watching Pooh's Heffalump movie with his young daughters. They loved it, and it was their special ritual. But eventually, they outgrew it. That version of his daughters, those toddlers, effectively died, and that phase of his life is gone forever. We think we have one big death at the end, but our lives are actually a series of endings. There's a season for being a young athlete, a season for being a parent to a child who still wants to hold your hand, and a season for intense travel. Once a season passes, you can't go back and buy it later. This is why time bucketing is so much more effective than a bucket list. A bucket list is reactive. You do it at the end. Time bucketing is proactive. You look at your life in 5-year chunks and ask, what experiences can I only do in this window? Eventually, you have to find your net worth peak. This is the point in your life where you should actually stop growing your wealth and start spending it down. For most people, this peak happens much earlier than they think, often in their 40s or 50s. If you keep growing your net worth until the day you die, you've spent your most valuable years of health and vitality accumulating resources you will never use. Perkins describes his 45th birthday party in St. Bart's as a metaphor for this. It was a massive expense, but he saw it as an investment in his fulfillment curve. He was intentionally declining his net worth to create a peak memory with the people he loved while everyone was still healthy enough to enjoy it. But how do you do this without actually hitting zero before you die? That's the longevity risk we're all terrified of. But Perkins suggests we're being bad insurance agents for ourselves. He points to tools we often overlook, like annuities. People often avoid them because they don't look like investments, but they're actually a way to outsource the risk of living too long. You pay a sum, and the insurance company guarantees you an income for life. By using tools like these, or even just life expectancy calculators to get a realistic sense of your timeline, you can stop over-saving out of a ghost story fear and start living more intentionally. There's also this idea of asymmetrical risk that changed how I think about my younger years. When you're young, you have very little to lose and everything to gain. He points to Mark Cuban, who took massive swings early on because he knew that if he failed, he could just go back to sleeping on a floor. As you get older, the stakes get higher, and your ability to bounce back decreases. This is why you have to be bold early. But boldness isn't just for the young. It's also the boldness to admit that time is running out and to act accordingly, even when it feels uncomfortable. Ultimately, dying with zero is an impossible task if you take it literally. You can't predict the exact second you'll pass away, but as a guiding principle, it's transformative. It shifts your focus from a pile of money to a gallery of memories. The traditional plan, working until you're 65 and then finally starting to live, is a trap. The health and time you have right now are resources that no amount of money can buy back later. Your life is the sum of your experiences. Every day spent just accumulating for an uncertain future is a day you aren't living. The golden years aren't waiting for you in a retirement community. They're happening right now, in whatever season you're in. The time to start living fully isn't after the next promotion or once you hit a certain number in your bank account. It's now. Because when it's all over, you can't take the money with you. But the memories, those are the only things that truly belong to you. If this changed how you think about your time, consider subscribing for more deep dives into ideas that actually matter.